First point on the covenant light, I don't think it reaches as far down into the middle market companies as one would think. I think there's still, we get calls all the time from banks, from lenders saying, you know, we have a company that's about to trip a covenant or has tripped a covenant. We want you to come in and talk to them about their alternatives before it's too late. I think second point there is that, you know, liquidity is still a great, you know, benchmark to see how well a company is doing. And when a company hits a wall and runs out of cash, you know, that's it, it's over. Who cares what covenant package it sort of started off with? So, you know, we're seeing a lot of different companies who now have faced the cold reality that once they do run out of cash, there's not this, you know, plethora of rescue or Band-Aid financing out there that's available to them, and that they really have to go out and seek alternative financing, like a change of control, and that's where distressed investors like myself will come into play. In the last cycle, because of the leveraged loan market was so frothy, we're seeing companies default with a lot more debt on them than in the previous cycle. I also think the players have completely changed. You have hedge funds, you have second lien guys and, you know, gals, and they haven't seen many cycles. And, you know, when you're coming in, we've been approached in a few deals to come and take a look at buying, you know, a second lien piece of paper at a huge discount, which would be the fulcrum security, and we could actually own the business, but, you know, the value just wasn't there. And there's a lot of these businesses where the value isn't even beyond the senior secured debt holders, let alone going to the next tranche. So I think you're going to see messier, as you say, you know, I think a lot more liquidations because the early signals aren't there. The players don't necessarily know how to react in a restructuring. And you also have a lot of companies that are now, frankly, owned by these hedge funds who had these loan-to-own strategies but are just ill-equipped to really deal with the fundamental operational problems of these businesses. There are plenty of opportunities to buy distressed companies or corporate carve-outs in good times. And in the bad times, we actually are a little more cautious, especially at the beginning of a down cycle. We really believe that the companies that are the worst in their respective industries are the first to fail. So we really are being very cautious right now in this environment and think in the next 6 to 12 months we're going to see just a lot of better companies who've encountered some issues and a lot of better opportunities.